Good morning. My name is Mark Cook. I'm a tax partner with Singer-Lewack. Thank you for attending this special presentation of the Singer-Lewack individual high net worth and family office practice on the subject of trust from a tax perspective. Joining me today is Terrance Pak and Shannon Carlson. A little bit about Singer-Lewack. We are a full service regional CPA firm with a national footprint. We serve clients in most industries and have capabilities in assurance and advisory, which include services such as financial statement audits and reviews. We have tax and tax advisory, which includes state and local tax and international tax, business management, back office bookkeeping, litigation support, valuation, and have offices throughout Southern and Northern California, Oregon, Nevada, and Colorado. Our mission at Singer-Lewack is to solve tax and business problems. And this presentation was designed to answer questions that we often hear from clients. For example, what is a trust? What is a trust designed to do? And what are the different types of trusts? And further, how can my family use a trust to accomplish goals such as passing assets to future generations? It's questions like these that spurred our interest to hold this webinar, and we hope you'll find answers to these and other questions as you listen to our very knowledgeable speaker on this matter, Terrance Pak. Terrance is a senior consultant in our tax advisory group, and throughout his career, he served high net worth clients and consulted on matters involving trust and estates. Terrance is an attorney and accountant. I think you'll find him to be an interesting speaker on this topic. We will have a Q&A session during the last few minutes of our time together. And if you have questions beyond that, you're encouraged to contact us either by email or by phone. So now I'll turn this over to Terrance.
Okay, great. Thank you. Thank you, Mark. Hi, everybody. I do just want to say thank you again for taking time out of your schedules to attend this webinar. And as the title suggests, the webinar is about the basics of the gift and the estate tax, as well as an effective primer or beginning primer on the use of trusts as an effective tax planning tool. And as Mark mentioned, the purpose of this webinar, or one of the purposes of this webinar, was to address a lot of the common questions that we typically get. So hopefully this webinar is informative and is helpful to you all. And just to reintroduce myself again, I know Mark already introduced me, but again, my name is Terrance Pak. I have a JD and MBA, and I've been a licensed attorney for about 6 years now. And I am a senior associate here at Singer-Lewack, based out of the Orange County, Irvine office in Southern California. So just a little bit of housekeeping before we get started. Our webinar is scheduled to go for about 45 minutes, so a little less than an hour. And we'll use the rest of the time, so the rest of the hour time slot that we've been allotted for questions and answers. So if you have any questions, you can please save them for the end. I believe there is a Q&A button on your Zoom window. So if you click on that, you should be able to type in your questions, and we, the panelists, should be able to see the questions. So just type your questions into there, and at the end of the webinar, we'll try to address as much of those as we can. And again, if you have any questions, maybe that comes up after the webinar has ended, please feel free to reach out to your tax manager or your point of contact here at Singer-Lewack, and he or she can help you. But if necessary, they can forward your question to me or to any one of the panelists here, and we can assist you with that. Okay, so enough delaying. Why don't we get started with the webinar? So in today's webinar, we'll be going over a number of items. First, we'll start off. First we'll go over the gift and estate tax in general. So I'll just cover the generalities of that as an initial matter. And then we'll start off by going over the definition and through some of the basics of the gift tax, as well as some gift tax specific provisions, such as the annual exclusion and the concept of gift splitting between spouses. From there, we'll move on to the estate tax, and similarly, we'll cover some estate tax specific provisions, such as the lifetime exemption, the unified credit, and portability of the exclusion amount between spouses. And from there, we'll wrap up the gift and the estate tax portion of the webinar by very briefly covering how they both, the gift and the estate tax, interact with each other, and why both should be considered for your overall tax planning. And then third and finally, the final portion of today's webinar will be with regards to trust. So first we'll go into an overview of trust by briefly describing the difference between revocable and irrevocable trust. And then from there, we'll cover some of the more common types of irrevocable trust that we typically see in our offices and we typically work on and advise on. And then lastly, we'll end the webinar by taking a brief look at a certain type of irrevocable trust that's been gaining some popularity lately, known as the spousal lifetime access trust. And let me just get my laser pointer here. So the spousal lifetime access trust, otherwise, they are also known as the SLAT. So that's our agenda for today. Okay, so before we dive into the gift tax, I want to approach both the gift and the estate tax from a very high mountaintop level. So generally speaking, both the gift and the estate tax are what's known as a transfer tax, which essentially means that the tax is assessed, or rather it's based off the facts or based on the grounds that assets are being transferred back and forth. So that's what a transfer tax is. And the amount of the tax is calculated based on the value of the assets or the property being transferred. So broadly speaking, the gift tax is a transfer tax assessed on taxpayers while they're still living, hence the term gift, which suggests a transfer of property from one living individual to another living individual. And the estate tax, on the other hand, is a tax on the assets that your estate owns upon your death. Right? So the estate tax is a tax on all the assets that your estate owns when you pass away, right before you transfer it out to all of your heirs, your children, your beneficiaries, charities, whoever you designate as the recipient. So it's a transfer tax on those assets. So for that reason, the estate tax is also sometimes known as the wealth tax, because the estate tax is essentially, it's a tax assessed on all of the assets that you've accumulated over your lifetime and held onto over your lifetime. So that's also why it's commonly known as the wealth tax, or sometimes referred to as the wealth tax. So we'll go into both of these taxes a little bit more, or much more in depth throughout this presentation, but I did want to start off from a very, very high mountaintop view before we go into the specifics. Again, I just want to reiterate that both of these taxes are what's known as transfer taxes and not income taxes. So it's not a tax on the income, it's a tax on the transfer of those assets. And I'll be kind of reiterating that point throughout the webinar, but I did want to start off by making that point. Okay, so now that we've explained both from a high level, let's go into each a little bit more specifically. And we'll start off with our first topic for today, which is the gift tax. So again, let's start from a very high level. Let's first define what the gift tax is. And if we look at the slide, I've provided a somewhat technical definition, but really the gift tax is defined as a tax on the transfer of property by one individual to another, while the gift-giving individual or the transferring individual receives nothing in return or receives something of lesser value in return. So that's the technical definition of a gift tax. So simply put, the gift tax is a tax on individuals who give gifts. So that's the simple definition of it. And again, to reiterate my earlier point, the gift tax is a transfer tax, not an income tax. So this means that the gift tax is generally assessed on the individual giving the gift as opposed to the individual receiving the gift recipient. Again, that might be a little bit counterintuitive. I think for most of us in the US tax system, you would imagine that the person receiving some sort of asset or some sort of property, it's like they're receiving income, so they would need to pay taxes on that. That is not the case with a gift. In the case of a gift, it's the gift giver who would be assessed the tax. So for those of you who may not have dealt with the gift tax before, or maybe haven't had much experience with it, you might be a little confused, or you might even be wondering if maybe you owed a gift tax for a gift that you were given in the past. So before moving forward, I just want to cover some very basic definitions. First, what is the definition of a gift? And if we take a look at the slides, another technical definition, but a gift is simply the transfer of property from one individual, a gift giver, to another individual, the recipient. And in that transaction, the gift giver receives nothing in return or receives something of lesser value in return. So that would be the technical definition of a gift. So naturally, the next question that I think a lot of people ask is, are all gifts taxable? Is that the case? Are all gifts taxable? And the answer to that is no. Gifts are only taxable if the value of the gift, or the value of the property being transferred is greater than a certain amount known as the annual exclusion amount. So if you look at the slides again, the technical definition of the annual exclusion is the amount of a gift that one individual may transfer to another individual per year without incurring a gift tax. So basically, an individual can gift up to a certain amount, up to this annual exclusion amount per year without incurring any sort of gift tax reporting requirement or gift tax liability. Just for your reference, this is a dollar amount every year. For 2021, that gift tax amount, the annual exclusion amount was $15,000, and it's actually been $15,000 since 2018. So 2018 through 2021, you have been allowed to give gifts of up to $15,000 per year to any individual without incurring any sort of gift tax reporting requirement or anything like that. The number does change. I'm not sure if it's going to change in 2022, but just for your reference, it does. So make sure to keep up to date with your tax advisor or your tax professional, just so you know when you're up to date about that item. Okay, so we can recap what we covered in just a moment. I know we covered a lot of stuff pretty quickly, but before that, I do want to mention that there are some types of transfers, some types of gifts that are not considered for gift tax purposes. So as you can see from the slide, gifts to your spouse, if you're married, and if your spouse is a US citizen, those are not considered for gift tax purposes. You can give, or you can transfer assets to your spouse in excess of $15,000, and there's no reporting requirement there. Gifts to a political organization or contributions to a political contribution, those are not considered gifts. Gifts to a charitable organization, so a charitable contribution, those are not considered gifts. And medical and educational expenses are also not considered gifts, but I do want to draw a little asterisk around that one specific item because there are a lot of nuances and a lot of gray areas with medical and educational gifts. Those nuances and gray areas go beyond the scope of today's webinar. But if you do have questions about that, you do want to make a gift for medical, for someone's medical expenses or somebody, a family member's tuition or something like that. You do want to, it's a case-by-case analysis, it's a fact-based analysis. So for those kinds of gifts, you do want to talk to your tax professional or tax advisor. But generally speaking, those 4 items on the slide are not considered gifts for gift tax purposes. So I know this might be a lot of information to some people. So let's try to put everything together, consolidate everything to an example, which I've provided here. So here we have an example of a couple, Jack and Jill, who intend to make gifts in calendar year 2021. So they make the following gifts this year. To their friend, Fred, they gave $7,500 in cash. To their grandson, Glenn, they gave $20,000. They paid the college tuition directly to the college. To their church, they gave $30,000 in cash in 2021. To their neighbor, Nora, they gave to their church, they gave $30,000 in cash. And to Nora, their neighbor, they gave $25,000 in cash. And to their daughter, Dorothy, they gave $40,000 in cash. So we want to find out which, if any of these, need to be reported on a gift tax return. So let's go through this exercise together. So for Fred, for their friend Fred, Jack and Jill do not need to take any action here. The gift that they gave was $7,500 in cash. It's below the $15,000 exclusion amount. no action needs to be taken. So this one was pretty simple. For their grandson, Glenn, let's say for simplicity's sake, in this example, Jack and Jill pay the $20,000 tuition directly to the university on behalf of Glenn as a gift. So that one, again, that one does not need to be reported if the education expense is paid directly to the school. But I do want to reiterate my earlier point. There's a lot of gray area with medical and educational expenses. So for any gift that involves an educational expense or medical expense, please do talk to your tax advisor just to make sure that it qualifies. But if we go on to the next item, Jack and Jill's gift of $30,000 to their church does not need to be reported because it's a charitable contribution. So again, charitable contributions or contributions to charity are not considered for gift tax purposes. And in actuality, a contribution to a charity, a legitimate charity, actually is a tax deduction. So instead of paying a tax, you actually pay less tax if you contribute to a charity. Now, Jack and Jill's gifts to Nora and Dorothy, so these are the last two, they have the same answer. Right? Well, their gifts of $25,000 to Nora and their gift of $40,000 to Dorothy, do those need to be reported? And the answer is maybe. It depends, and it depends on the concept of gift splitting. So I'm not sure if you remember, I mentioned gift splitting earlier on in the agenda. So what is gift splitting? And if you remember that an individual, so for gifts, an individual is permitted to give $15,000. So in 2021, you're allowed to give $15,000 tax-free, report-free to another individual, right? So by logical extension, if someone is married, a married couple can give up to $15,000 each to another individual, right? Resulting in that recipient individual receiving $30,000 as a gift. And this is what's known as gift splitting. So in our previous example, Jack and Jill, they can both give $15,000 each to a recipient, and that recipient, and Jack and Jill do not incur any sort of gift tax reporting requirements or any other action needs to be taken for them. So that's what's known as gift splitting. And if we take that situation a little bit further, right, a married couple can gift up to $60,000 to a recipient if the recipient is also a married individual, right? So for this to work, let's take a look at an example again. Jack and Jill, a married couple, can both give $30,000 or $15,000 each, so $30,000 in total to a recipient. And then Jack and Jill can give $30,000, $15,000 each to the recipient's spouse. And that way, that recipient family, that recipient couple, can get up to $60,000 tax-free, report-free. There's no action that needs to be taken. So that's what's known as gift splitting. And I think for some people, they might ask, why would you want to do this? Why do you want to give all these, gifts away for free without any gift tax reporting requirements? And the reason typically is, this is an easy tax-free way to lower the value of your estate. It's an easy way to get cash and assets out of your estate, right? And why do we want to do this? We covered it earlier because we want to lower that estate tax that you might have to pay when you pass away. So we'll cover that in a little bit more detail later on, but for now, why don't we revisit our old example? So this is the exact same example, same slide. So we don't have to focus on the first three. Let's focus on the last two here, Nora and Dorothy. So I tried to have a visual here so that we don't have to read as many words. But here, Nora, their neighbor, Jack and Jill's neighbor, receives $25,000 in cash, right? So how do we make this, how do we structure this in a way that there's no gift tax that needs to be reported or gift that needs to be reported? And the way to do this is Jack can gift up to $12,500, which is below his $15,000 exclusion amount, to Nora. Similarly, Jill can gift $12,500, which is again below her $15,000 exclusion, to Nora as well, which results in Nora receiving $25,000 tax-free, right? So using the concept of gift splitting, they're able to transfer, Jack and Jill are able to transfer $25,000 of cash to Nora without incurring any sort of gift tax reporting requirement or gift reporting requirement, even though the gift technically is greater than $15,000. So hopefully that's helpful in demonstrating how gift splitting is used. And why don't we look at another example here? This is Dorothy, their daughter, Jack and Jill's daughter, and Dorothy is set to receive $40,000 in cash, or they want to give $40,000 as a gift to Dorothy. So here, if we use gift splitting again, Jack can give $20,000 to Dorothy, and Jill can give $20,000 to Dorothy. They can do this by splitting the gift, but because their respective gifts are greater than $15,000, only $15,000 of this $20,000 amount will be tax-free, and then the remaining $5,000 must be reported. Similarly here, $15,000 will be tax-free, and the remaining $5,000 must be reported. So this would be the result. I do want to mention, I know, I don't want to confuse anybody here. I mentioned earlier that the gift tax is a transfer tax. So this $10,000 that must be reported right here, I know it's under Dorothy's bubble, but actually, just to make sure nobody gets confused, in this kind of situation, it's Jack and Jill who have to report the $10,000, not Dorothy. So I do just want to make that point again. In this kind of situation where a gift is greater than that exclusion amount, it's not Dorothy who's penalized, or it's not Dorothy who has to take any further action. It's Jack and Jill as the gift givers who have to do that. Okay, so why don't we throw a little bit of a wrinkle into this example? And let's say Dorothy was married to a US citizen. So let's say Dorothy was married to husband Hank. If we have that, right, then we can very easily transfer these funds to Dorothy and Hank tax-free. We have Jack and Jill here. They both give $10,000 each to Dorothy, resulting in $20,000 being transferred to Dorothy. No gift tax reporting requirement has been triggered. Similarly, Jack and Jill, they give $10,000 each to Hank, and Hank gets $20,000 tax-free, no gift tax reporting requirement. And the end result is Dorothy and Hank, this couple, they receive $40,000 from Jack and Jill. So I think the last two examples, Dorothy and Nora, they demonstrate how gift splitting can work. I do want to make a small note for this kind of situation with Dorothy and Hank. It is important that all the spouses agree to the gift splitting, right? So the reason why I mentioned that is, let's say Dorothy and Hank are in the middle of getting a divorce, right? They're getting a divorce. If Jack and Jill give $20,000 to Hank and ask Hank, hey, can you give it to Dorothy? Hank does not have to do that, right? So even though Jack and Jill want to give Dorothy, their daughter, $40,000, they don't want to give their son-in-law or their soon-to-be former son-in-law, any money. They can't force Hank to share it with Dorothy. So I do want to just mention, you do want to be cognizant of that. All the spouses do it to agree to split the gift. Okay, so hopefully nobody is confused. If you are confused, please feel free to write a question in the Q&A box, and depending on the time, hopefully we'll have time to go over any other questions you may have. Okay, so hopefully those examples were helpful, but I do want to go over the consequences of gifting in excess of the annual exclusion amount. So if you give a gift in the calendar year that's greater than the $15,000 exclusion amount, or maybe after you've utilized the gift splitting methods, you're still above that gift exclusion threshold, then you are required to report the gift on a gift tax return. And the gift tax return is known as Form 709. So if you hear your accountant talking about the 709 form, just know that we're talking about a gift tax return. And I do want to make a note, the gift tax return is different from your income tax return. So when you are preparing your tax return, if you gave a gift or if you received a gift that was greater than the exclusion amount, it's not the right call to just say, hey, to your accountant, I got a gift, please report this in my tax return. That's not the proper procedure. You have to file a separate form, a separate tax return for your gift. And those are typically due, I think, around the same time as your income tax return. So try not to get too confused. Make sure you let your accountant know or your tax professional know whenever you've given a gift or received a gift, just so that everybody's aware and up to speed with the compliance. Okay, so I did want to make that note. And I did want to pose the question, if you are required, if you do give a gift that's greater than $15,000, are you required to pay a gift tax on the amount that's above the exclusion? So if you're single and you give a gift of $20,000 to another single person, so it's $5,000 over that exclusion limit, are you required to pay a gift tax on that excess amount, that $5,000? And the answer, again, is it depends. And it depends on whether the gift that you give is greater or less than what's known as the lifetime exemption amount, otherwise known as the unified credit amount, or sometimes referred to as the basic exclusion amount. I know I'm just throwing out a lot of words, but we'll go over those right now. Yeah, I just keep on throwing out new concepts. So hopefully I haven't lost anybody yet, but I do want to take some time to explain what's known as the unified credit. And right after this, we'll go into another visual. So hopefully it'll be easier. But let's just go over this right now. So as you can see from the slides, the lifetime exemption, right? The lifetime exemption, the technical definition is that the lifetime exemption is a designated dollar amount that every US individual is allowed to use to offset a gift or estate tax that's been assessed against that individual. So what does that mean? Right? Essentially, in simple terms, it means that the government has designated an amount that you can give as a gift or that you can own in your estate. So essentially means that there's an amount that you can transfer without paying a gift or an estate tax, right? It's the exclusion amount. You can gift up to that amount, you can transfer up to that amount without triggering or without paying any sort of gift or estate tax. If you give a gift or if you make a transfer that's higher than that amount, that excess portion will be subject to the gift or the estate tax. So in other words, you have a cushion, right? You're allowed to, in this cushion, you're allowed to transfer a number of assets tax-free. Once you've used up your cushion, then everything else will be taxable. So as I mentioned, the exclusion amount is a dollar amount. Just for your historical knowledge, right? The exclusion amount was set at $5 million back in 2011. Right? So in 2011, was it Obama, President Obama, he set the amount to $5 million and said, okay, this is the amount, $5 million, you transfer up to this amount, and anything above that will be taxable. That $5 million increases every year due to inflation. So as of 2017, that amount had increased from $5 million to $5.49 million. So it had increased from 2011 to 2017 up to $5.49 million. However, in 2017, some or all of you may have remembered President Trump and the Congress, the Senate, they passed a pretty big tax law, the Tax Cuts and Jobs Act. And there were a lot of changes in that law, but one of the big changes was that the exclusion amount was set to double. So the exclusion amount was doubled for years 2018 through 2025. So for those 7 years, the exclusion amount jumped up. So 2017, the amount was 5.49 million. In 2018, the exclusion amount doubled to $11.18 million. So for your reference, the amount of the exclusion in 2021, this year, is $11.7 million. And it'll if the law does not change, it'll probably stay within this $11 to $12 million range up until 2025. Beginning in 2026, the exclusion amount will go back down to about $5 to $6 million, because that's when this sort of double bonus exclusion amount expires. So, okay, I know I just talked so much. Let me just go over a visual diagram. Hopefully this explains it a little bit easier for people. But as you can see, in 2017, right, 2017 here, the exclusion amount was $5.49 million. That means you could transfer, you can give a gift of $15,000 plus $5.49 million without triggering any sort of gift tax or estate tax. Alternatively, when you pass away, you can own assets worth $5.49 million and you won't have to pay an estate tax. After the passage of the Tax Cuts and Jobs Act in 2018, you can see this blue portion here. This is what's known as the bonus exclusion. So the exclusion amount doubled from 5 million to 10 million. And because it's indexed for inflation, or it increases every year due to inflation, this amount increased 11.18, 2019, 11.4. If we skip to 2021, it's 11.7 million this year. 2022, again, theoretically will increase, but we'll have to wait to see if there's any sort of developments in Congress. So I'll just linger on this slide a little bit just so people can take a look. I do want to mention a couple things. One, after President Biden came into office, one of his, I guess, the cornerstones of his campaign was to revamp the tax law and roll back a lot of the changes that President Trump made. So there is a somewhat real chance that these bonus exclusion amounts will disappear in 2022. There is also a chance that it'll disappear in 2021 too. That's probably not as likely, but there is a chance that these bonus amounts for 2022 onwards will be eliminated. As of this morning, I haven't checked, or as of, I guess, a couple of days ago, I don't think there have been any developments on that front, but we do hear at our office, we do hear rumblings of a new tax law kind of making its way through Congress, or at the very least, a lot of tax changes making its way through Congress. So please, keep in touch with your tax professionals. At our office at Singer LeWak, we do have tax alerts that go out informing our clients of any changes in the tax law. So keep an eye out for those. Please sign up if you are not already signed up, and we should send you an email as soon as we hear word of any big major substantive changes to the law. So again, this bonus exclusion amount is set till 2025. And one other thing that I do want to mention is this exclusion amount. This is what's known as the basic exclusion amount. This $5 million, and then increase to 10 million for 2018 to 2025. The basic exclusion amount is different from the annual gift exclusion, right? So I know they sound similar because they use a lot of the same words, but they are different. So I do want to make sure that point is firm in everybody's knowledge. The gift exclusion amount is an exclusion per recipient, whereas the basic exclusion amount is an exclusion per gift giver or per donor. So in my previous example, Jack and Jill, right? So Jack can give $15K to his neighbor. He can give $15,000 to his friend, another $15,000 to his daughter. Every single person, there's an annual exclusion amount that he can use up. But if Jack gave $15,000 to his neighbor, and then on top of that gave his neighbor another $1 million, then what would happen is Jack's exclusion amount would decrease from 11.7 to 10.7. That $1 million does not come back if he gives, it's not as though if he gives his neighbor Nora, a different friend, $15,000 plus another $1 million, he doesn't have 11.7 million to give to another friend. He only has $10.7 million left. So I do want to make that point. There are two different things, the annual exclusion and the basic exclusion amount. I do see it's 11:05. I think I'm about halfway done, so I'll try to speed up a little bit. Okay, so now that hopefully we have a basic understanding of the lifetime exemption or the basic exclusion, let's move forward with the estate tax. Now, the estate tax is a little bit different from your normal income tax return. And again, that's because the estate tax does not tax your income. Rather, it's a tax on the value of the assets held by your estate on the date of your death, right? So as I mentioned earlier on, it's sometimes referred to as the wealth tax. And the reason for this is because it's just a tax on all the value of your assets before you transfer them out to your beneficiaries, your children, family members, et cetera, et cetera. Okay, so to calculate the estate tax, here's a simple formula for you. We first have to determine the total estate. So all the value of the assets in your estate, let's add them all up. And then let's subtract out the exclusion amount. So usually the $11.7 million that if you passed away this year in 2021, and you didn't use any of your exclusion, then this amount would be $11.7 million. So you take your total minus your exclusion, whatever is left over, if it's above zero, that portion is taxable. So that portion is taxable. Now let's go over this exclusion amount one more time. Yeah, as I mentioned, the exclusion amount is normally just your lifetime exemption, right? So in this case, it would be $11.7 million. So usually it's just that or whatever's left over if you use any of it during your lifetime. However, in some cases, the exclusion amount can actually be higher than your lifetime exemption. So let's say you passed away in 2021. Typically, your exclusion amount would be at most $11.7 million. However, in some cases, it could be higher than $11.7 million. And it can get that way through a process known as portability. Portability, so if you have really great memory, you might have remembered from our agenda, I said we'll cover something what's known as portability. So again, through portability, you could actually have a slightly higher exemption amount. So before we cover portability, I think we've been covering so much information. Why don't we just go through a quick example real quick. So let's look at this example involving Alan. So Alan passed away, and these are the assets that he held. He had a primary home, vacation home, all these assets. If you total it all up, it'll come up to $7.05 million. So that's the value of his estate, the gross estate. Now, let's say Alan passed away in 2017. So if you look on the left-hand column, this is just the previous slide, the information from the previous slide. So right here, what if he passed away in 2017? So we'll use our formula, the gross estate minus the exclusion amount. So in this case, the total estate is $7.05 million. In 2017, right, this was before they doubled the exclusion amount. The exclusion was $5.49 million. So if we follow this formula, only $1.56 million of his estate is taxable. And from there, we would apply the estate tax rate. I actually didn't prepare the actual estate tax liability, but generally speaking, the estate tax rate is about 40%. So 40% of this amount, almost 50%, that's how much you have to pay in estate taxes. Yes, so this is essentially what his taxable estate would be in 2017. Again, this is a very, very simplified example, but just to kind of get you a little bit aware of what the situation is or how to calculate the estate tax. Now, if we take that same example, right, and then we assume that Alan passed away in 2021, so this year, instead of 2017, we would follow the same formula. 7.05 million is his total estate. That's the total estate. The exemption amount, the exclusion amount is $11.7 million in 2021, right? So if we take the difference, right, if it's $0 or more, we just put $0, or if it's $0 or less, we just put $0 here. So in this case, there's no portion of his estate that is taxable, right? So he does not have to file an estate tax return. He does not need to file or pay an estate tax, right? But if we look here, there was 4 million of that exemption, 4.6 million of that exemption that was unused, right? So that's the difference between 11.7 million and 7.05 million. So 4.65 was not used up. And I guess some people have asked, or I guess you might want to ask, is there anything we can do with this unused portion? And the answer is yes, if you're married, So upon the death of the first spouse, so if Alan was married as of the date of his death, right? So when he passed away, if he was married, then the surviving spouse, his surviving spouse can utilize what's known as portability. And essentially what that means is the surviving spouse, can port over Alan's unused exemption to herself. So in our previous example, he had about 4.65 million of unused exemption. She can transfer or port over that 4.65, attach it to her exemption amount, and that way she'll have her 11.7 million plus 4.65 million as part of her basic exclusion, or as part of her exclusion amount, right? So this is what's known as portability. And yeah, as you can see from the slide, it's when the surviving spouse ports over the unused portion of the deceased spouse's exemption to herself. This is sometimes known, or this is known as the deceased spouse's unused exemption, AKA the DSUE. So if you ever hear us accountants talking about DSUE, this is what we're referring to. So I do want to make a note here. So in our previous example, Alan, if he passed away in 2021, he did not owe an estate tax and he did not need to file an estate tax return, right? No tax liability, no tax return needs to be filed. However, for Alan's surviving spouse, if she wants to port over the unused exemption, she will have to file the estate tax return, right? So she has to file the estate tax return just to port it over. So that's just a planning tip for people here listening. If you have a spouse who passed away recently and you want to see if you can port over the estate tax, it's not an automatic procedure. You do have to file the return. And then just from a procedural level, the estate tax return, that's what's known as Form 706. So when you hear us talk about 706, we're talking about the estate tax return. If you hear us talking about a 709, that's the gift tax return. So it's okay to be a little confused about the numbers. Just ask us for clarification, we'll help you. But the 706 is the estate tax return. And again, even though you don't owe an estate tax, there might be a good reason to file the estate tax return for portability reasons. And then just for your information, the estate tax return, the due date is 9 months after the date of death. So you have time to, take care of your affairs and things like that. Don't come right away to our office. Take some time and then you can come in. If you need more time, there is a 6-month extension that's available. So that's just for your reference. That's the timeline for you guys to follow. Okay. So yeah, I do want to say again, the only way to get that portability is to file the estate tax return. It might be worthwhile, if you had a spouse who passed away within this 2018 through 2025 period, it might be worthwhile to file the estate tax return and get that portability, because we don't know what kinds of changes will come, tax law changes will come. It's looking more and more likely that there will be some sort of new tax law introduced. Whether it gets passed, I'm not sure, but definitely it's in the works right now. Because this bonus exclusion is only here for a limited time, and it might be even more limited, it might get cut short early. So you do want to maybe take advantage of those kinds of planning opportunities. Please feel free to come talk to us, at Senior LEWAC or to your estate planning attorney. Try to find a plan that's best for you. Try to take advantage of this situation currently. Okay, so to wrap up our portion on the gift and the estate tax, I know it's 11:15 already. I just want to make a final note that they are obviously related to each other. So gifts in excess of the annual exclusion amount are offset by the lifetime exemption amount. And because the exemption amount is so much higher now from 2018 through 2025, there are lots of planning opportunities. Please feel free to schedule a call with your point of contact here at Senior LEWAC. And certainly we'd be happy to help you. And then just again for your reference, here is the chart again. And okay, well, I think I have to speed it up a little bit. So let's move on to our final portion of the webinar, which is a brief discussion of trust and how trust can be used in the estate and the tax planning process, right? So from a high level, a trust is defined as a legal arrangement in which somebody, in this case a settlor, or sometimes what's known as a trustor, a settlor or trustor entrusts a trustee to hold title to various assets for the benefit of the beneficiary, right? So I put simply, what does that mean? As you can see from the chart, it basically means that the settlor or the trustor, they give their assets to the trustee, and the trustee will hold those assets and give it to the beneficiaries when the time is right. Typically for a trust, there's normally a trust document that's attached, and in that document, the trustor or the settlor, they write out all the instructions for the trustee, what the trustee can or cannot do, what the trustee should and should not do, and when the trustee should distribute those assets to the beneficiaries. If you look at this diagram, you'll see there's a third person here, the protector. This is, for the purposes of our webinar, we don't have to worry about this, but a protector is typically somebody who just comes in, offers some advice. Sometimes you need the protector's consent the trustee will need the protector's consent to, like do certain things, but we don't have to worry about that for today. So broadly speaking, there are two types of trusts, a revocable trust, REV, and an irrevocable trust, IRRE, so revocable and irrevocable. And the main difference between the two, simply put, is that one is revocable and the other one is not revocable. So it's irrevocable. And that might seem simple enough, but for tax purposes, it's pretty big distinction, right? Because if something is irrevocable, it's if an asset has been put inside of an irrevocable trust, it's been irrevocably transferred, and the trustor, the settlor, cannot get it back, right? For those purposes, that asset is considered to be removed from your estate, right? So in other words, when you pass away, those assets will not be included when you're calculating your estate tax, right? So for that reason, it's important to make that distinction. On the other hand, assets in a revocable trust, REV, revocable, those assets are considered to be included in your estate, right? Because the trust can be revoked at any time and you can just get those assets back, right? So for a revocable trust, since the authority over the assets ultimately remains with the trustor or the settlor, it's considered to be included inside of your estate. So why don't we very, very quickly go over the basics of the revocable trust, REV, revocable. Very quickly, this webinar doesn't really cover revocable trust because there's not actually that much tax planning that can be done with revocable trusts. But generally speaking, a revocable trust is also what's known as a living trust. And I think many people here, probably many, if not everybody here, probably has a living trust. But basically, the benefits of a living trust are to avoid probate. It's to have lower fees upon your death or upon your passing. It promotes an easy administration, so the assets can easily be distributed to your beneficiaries. And it also maintains a certain level of privacy over your assets and over your affairs after you pass away. So it's a private arrangement. You don't have to go to the courts or anything like that. That's typically why a lot of Californians especially like living trusts. In California, the probate fees are pretty expensive. I think in other states it's not as expensive. I do think there might be some non-California residents attending this webinar, so maybe for you guys this would not be as applicable, but typically that's the benefit of a revocable trust. Okay, so an irrevocable trust, again, it provides, generally speaking, a trustor who creates an irrevocable trust and transfers assets into the irrevocable trust. That asset, generally speaking, is outside of your estate and it's no longer part of your estate and not considered in the calculation of your estate tax, right? So that's one benefit. Another benefit for irrevocable trust is asset protection. So a lot of individuals, they'll create an irrevocable trust because, you know, maybe their occupation prior to their retirement was one with a lot of liability. So they just want to protect their assets. So that's another positive reason for irrevocable trust. Yeah, I'm so sorry. I'm just going through this so quickly. But some common types of irrevocable trust that we see in our office are spousal lifetime access trusts, or SLATs, life insurance trusts, or irrevocable life insurance trusts. We typically see those. Grant to retain interest trusts, qualified personal residence trusts, charitable remainder trusts, retirement trusts, dynasty trusts, domestic asset protection trusts. We do see all of these in our office. So I guess the point here that I'm trying to make is, you know, please do not hesitate to consider consulting with our office. Obviously, there are some things that are in the realm of the attorney, and the attorney has to draft these trusts and make the specific provisions. But you know, we do have experience, so you know, this is sort of our or me sort of indicating that, you know, do not be hesitant or reluctant to reach out to us or connect us with your attorney. We do have experience with these, and I think our input is probably maybe not just as valuable, but very important in the drafting of these trusts, so that your tax situation is protected. I think we only have 7 minutes, so I did want to go through a SLAT, but I think we might not have enough time. So maybe I'll save this for a future webinar, maybe webinar part 2, and I can just move forward to the very end. Yes, so I think we'll just end it here, and then we'll just go into our Q&A session. So I know we covered a lot of topics. I realized I've been speaking for almost an hour, so I know we covered a lot of information. So if anybody has any questions, please feel free to type them into the Q&A session now, or Q&A box now. And yes, Q&A now. And I also, before we do the Q&A, I actually did want to introduce our third panelist, Shannon Carlson. She's a partner at the Riverside office, in our Riverside office, and she's the leader of the high net worth sector. So I did want to give a little bit of time to her. I know we only have 5 minutes, but I just want to give her an opportunity to introduce herself.
Thank you, Terrance. I appreciate all of the information you provided us with today. It was great. I'll be quick. Good morning, everyone. I am Shannon Carlson. I am a tax partner in the Riverside office, and I am the sector leader for our high net worth individual sector. Our group focuses on a variety of issues affecting high net worth individuals. In addition to gifts, estates, and trusts, which Terrance has covered today, we also offer comprehensive planning, both compliance and consulting, business management, family office services, succession planning, charitable giving plans, business valuations, and more. Basically, if a problem plagues you, we want to help you solve it. We hope you found this presentation valuable, and we encourage you to check in with any one of us if you would like to learn more about any of these topics or participate in future webinars. Thank you so much for being with us today. We really appreciate you. I don't see any questions in the Q&A. If anyone has anything, toss it in there really quickly so we can try to address it. I'm going to assume that Terrance answered all of your questions, but if he didn't, please reach out to us. You have our email addresses here on the screen, and we'd be happy to help you. Thank you again for attending today. Terrance, thank you for your presentation. Again, we really appreciate you all, and wish you a lovely day.
Thank you.